Good afternoon, Jeremiah Conjure here from Annuity Association. And today we're going to be doing another unbiased annuity review covering the Silac Insurance Company Denali Fixed Indexed Annuity. Really excited to cover this annuity today. It's been one of the up-and-comers, if you will, in regards to making some headway in the marketplace because of some of the unique features that are offered inside of this annuity. And the one key being that it's the first indexed annuity to offer a lifetime income rider at zero fee, zero charge for the lifetime income rider. So it's very unique, very uniquely positioned in the marketplace as on average, the lifetime income riders on an indexed annuity are anywhere from 1% to 1.5% on average of an annual fee per year. So definitely excited to cover this annuity for you. And we're going to be discussing not only the income rider component of the Silac Denali fixed indexed annuity, but we'll also be discovering all of the features and benefits. We'll be taking a look at how the contract earns interest based on the indexing strategies that are found within. And we'll be diving in also to the historical performance of this annuity and looking back over a period of time to see how it would have performed in the event we owned this contract or this annuity during that time frame. So very excited to cover that. Before we dive in, I will be covering our disclaimer. So if you'll just bear with me as we can get this out of the way, and then we'll get started. So let me go ahead and share my screen with you guys, and we'll dive right in. All right. So this is a review, not a recommendation to buy or sell an annuity. Silac has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of annuityassociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. So that kind of leads me into just discussing real briefly on, why we're doing these types of reviews. And, I've kind of always try to put myself in other people's shoes when it comes to doing anything in life. And, one thing that I know that I do for sure, regardless of what it is that I'm looking at buying or investing, is I like to do my own research. I like to do my own, checking out the different product reviews and track records of the types of products or the company that I'm looking at buying or investing with. And so that's the premise of these reviews, is to give you an unbiased review on the features, benefits, rates, and more so that you can ultimately make an educated decision on if an indexed annuity is right for you, and if so, which one's going to serve your needs the best. Not all of them are created equal. It's really why we started Annuity Association in the first place, is because upon entering this industry with the hundreds of different annuities that are available on the marketplace today, it was very difficult for me as an advisor to really know which one was best for my clients. So we developed a company, we started our own firm to specialize in the education and review and ultimately changing the buying process of annuities in general so that you, the end consumer, can help yourself make an educated decision on which one you should select if you do decide that they're right. So I'm a big believer in indexed annuities and what they're built to serve, the purpose and the intended purpose, more importantly, of why you should buy one. So if you're looking to avoid market risk, if you're looking to grow your money safely and you're not finding the interest or the yield that traditional safe money instruments used to provide, things like bank CDs, money market accounts, things of that nature, low risk, traditional safe money instruments. If you can't find the yield that you're looking for, an indexed annuity is a great alternative to consider. And we typically can see them performing anywhere in the 4 to 6% range conservatively. So bear with me. I'm going to go ahead and dive right into the product brochure. We'll cover that in some detail, and then we'll dive into the analytics of our review. So bear with me. Okay, share screen. Here we go. Hopefully everybody can see that. If you're watching this on Facebook or YouTube, you can enlarge the screen by clicking in the bottom right-hand corner of your viewing screen, and it should make it larger for you. So again, we're reviewing the Silac Insurance Company, formerly known as Equitable Life, the Denali single premium fixed indexed annuity. So we'll cover some of the brochure here and some of the quick pointers that they make in the brochure. So one of the first questions that they ask is, do you feel uncertain about retirement? It's almost impossible not to during the days that we're living in and the current economy and stock market and all the turbulation that we're experiencing in every facet of life. It's really hard to go into retirement, a brand new phase of your life, with any certainty. I mean, it's just almost impossible. So 80%, if you feel that way, 80% of Americans are nervous about retirement. And next question is, do you have a retirement income stream that you can't outlive? Most don't. So if you look at traditional retirement planning, and just 2 or 3 generations ago, my grandfather included, back then they had a thing called a pension. And a pension was what was used in combination with your Social Security, that when combined, those monies would usually cover your basic cost of living. Baby boomers today that are retiring are the first generation to retire with less than 13% of that population having any form of pension. So majority of those people are finding themselves with money in their retirement accounts, such as their 401ks, and they're looking for a way to create an income stream. So today's day and age, most people don't have pensions, and therefore they do not have a retirement income stream that they're certain they can outlive. 73% of Americans are concerned about having a lifetime income, about not having a lifetime income, excuse me. And do you have a plan that can protect you from surprises? So those unexpected spending shocks that we most likely will experience at some point in time in retirement, we need to have a plan for those. And it's okay if you don't. Silac Insurance Company and the Denali fixed indexed annuity is here to help. 71% of Americans are concerned about the risk of a financial surprise. So down below that, it says the Silac Denali series provides guarantees where you need guarantees and flexibility where you need flexibility. And it's the right combination that ensures you're ready for life's uncertainties and leads to a retirement elevated. So the Silac Denali series may be a good fit if you're looking for guarantees. So that's the number one reason people buy annuities, whether it be an income annuity or a fixed annuity or an indexed annuity, is in any type of annuity that you buy, you're getting some form of contractual guarantee. And in the Silac fixed indexed annuity, the first guarantee that you're getting is that you're getting a guarantee of what's called principal protection. In all fixed indexed annuities, contractually backed, you're getting a 0% floor, meaning regardless of market volatility, your money will stay whole every single year and not go down in the event the market does drop. So you're getting that first guarantee there. In addition, it says you can choose the certainty of a fixed interest rate that is annually declared and subject to minimum guarantees. Your annuity also has a minimum guaranteed value. So that minimum guaranteed value is the 0% floor. And in the event of a market performance that is negative, your money will stay right where it is. You can never go down below your initial investment amount due to market volatility. Growth potential. You also have the choice of interest based on the performance of an external market index. So the key word here in an indexed annuity is that word index. Based on the type of annuity, or rather the product that you select in the indexed annuity marketplace, there's going to be a handful of index strategies and index crediting options, and that is how your money will grow when allocated to those index strategies. We'll be covering that in more detail momentarily, so just stay tuned. Protection of principal. Your savings are always protected from market fluctuations and are 100% principal protected. There is no direct downside market risk to your funds. Tax deferrals. Save more for retirement with tax deferred growth. The Denali series allows you to keep more of your retirement savings working for you by deferring taxes until you choose to access the funds in your annuity. So that's one of the ways that an indexed annuity differs from a traditional bank certificate of deposit. Rather than having to declare the interest that was grown over the annual time frame or every year, on an indexed annuity, you can defer the growth and defer the taxes on the growth over the length of the contract. Income that can't be outlived. The lifetime withdrawal benefit is automatically included and ensures that you can generate a lifetime income that will last for your life. Higher income in a time of need. So to help prepare for the unexpected, the Denali series can offer higher withdrawals for a period of time if certain health conditions are met. We'll be diving into that momentarily. Access to funds. So multiple liquidity options are available to help you when your life throws a curveball. After the withdrawal charge term, you can always access the full account value of your annuity with no surrender charges. And then wealth transfer. Leave a legacy for your loved ones and avoid probate. The full account value is available after your death. If your spouse is the beneficiary, then he or she can always choose to continue the policy. So one of the number one misconceptions of the annuity business is that when you die, the annuity company keeps your money. That is 100% false. And about 99% of all annuities out there on the marketplace. The only type of annuity that actually happens is if you buy what's called a single premium immediate annuity, and you buy it structured with life only provisions. So what that means is that's a type of income annuity that'll pay out for the rest of your life. But if you structure it for life only, then what that means is if when you do pass away, the income stops and there's no money left over to go to your beneficiaries or your spouse. That's the only annuity that does that. So please note that this indexed annuity and 99% of all other annuities out there do not keep any of the money in the event that you pass away. 100% of whatever's left in the annuity goes to your beneficiaries, and in addition, avoids probate, which is very, very good. So to get started with the Denali, it's all about two easy steps. Number one, choose the length of your product. This particular annuity offers a 7, 10, and 14-year term period. So basically what that is like any other safe money instrument, we call it a time deposit. Rather than taking market risk in exchange for no risk, you're signing up for a term product. So they offer a 7-year product, which means you'd have to keep your money in there for 7 years to be able to access 100% of the monies at the end. If you access any of the monies during that 7-year period, there's a 5% free withdrawal provision, but anything above 5% would have a surrender charge charged to those dollars above that 5% threshold. There's also a 10-year product and a 14-year product. In the indexed annuity world, rule of thumb is that the longer you sign up for, usually it's going to offer the higher amount of growth potential because they'll offer you higher rates on the participation rates or crediting options that are found in the contract. So typically a 14-year indexed annuity will offer higher growth opportunity than a 7-year indexed annuity as a good rule of thumb. Number two is decide how you'd like to grow your money. The Denali series offers you flexibility to place your money in different crediting strategies tied to different external market indexes. By placing your money in multiple interest crediting strategies or indexes, you can have diversification within your annuity. Very important. A lot of people don't look at that when initially coming across indexed annuities and learning about them is that inside the indexed annuity itself, there's usually anywhere from 2 to 5 different indexes that are found in the annuity that you can choose from. And if you'd like, you can diversify and put a portion of your money in one index and a portion of your money in the other index and a portion of money in the third index, if you will. And by doing that, you're diversifying because the index strategies that are found in them are usually different. So you're, able to choose different indexes based on, the way that those indexes are comprised. And it just adds a layer of diversification to help you ultimately earn interest every single year. So let's talk about how your money will grow. So with those multiple crediting strategies that are available to choose from, the crediting strategies are used to determine how much interest, if any, will be credited to your annuity. You can allocate your funds among one or more of the available crediting strategies. You can reallocate at the end of each crediting strategy term and gain comfort knowing your money is working for you and is protected from market fluctuations. The Denali series crediting strategy provides the following benefits. So we've talked about the first one, that annual floor protection of 0%. No matter what happens with the underlying index, you will never earn an interest credit less than 0%. Very, very important. If you were to compare that to being in the equities or stock market, when the market goes down and your stocks go down, then you're going to see a negative performance for that period of time. In this, the worst case scenario is a 0. Very important. Number 2 is the interest credit is locked in. So once interest has been credited, it is locked in and cannot be lost due to a future market change. Number 3 is choices. So you have those multiple crediting strategies to choose from, and you can change your mind each strategy term. They also offer a very competitive fixed interest strategy inside the Denali series. At the time of this recording, the fixed rate, just like a fixed rate on a savings account or a fixed rate on a bank CD, the fixed rate in the indexed annuity on this particular product at this time is 3%, guaranteed for the year, and it renews every single year. So they can lower that rate, they can increase that rate every single year, but when you sign up for it, you're at least locked in for that 1 year. It's 3%. That's, that's about 3.5 times higher than the average bank CD at this present time. So very, very attractive there. And on the indexed crediting strategies, provide interest credits that are tied to the performance of an external market index. Interest is credited at the end of the crediting strategies term. You are guaranteed to never earn less than 0% interest for the strategy term, even during market downturns. This is one of the key features of a fixed indexed annuity. In order to provide the annual floor protection of 0%, index crediting strategies limit the total interest you can receive. This limit is in the form of an adjustment, or also known as a cap, participation rate, or spread. Next year's adjustments will be declared at the end of each crediting strategy's term. So we'll be covering those cap, participation, and spread rates found inside of this annuity so that you can get a deeper understanding of how they work. But before we get there, let's talk about the features of the lifetime income component on the Denali series index annuity from Silac. So the Denali series allows you to create your own pension. You can begin taking lifetime withdrawals after 1 year. Your lifetime withdrawal amount depends on your current account value and your age when you start lifetime income withdrawals. The lifetime guarantee is that withdrawals are guaranteed for life as long as you don't take any excess withdrawals, even if your account value falls to 0. An excess withdrawal will lead to a recalculation of the lifetime withdrawal. So when you get to that part of your retirement where you say, okay, now I want to create this annuity to a lifetime income stream, Silac will give you a predetermined amount based on 2 important factors: how much money is in the account and how old are you. They'll give you that amount that will be guaranteed for the rest of your life, whether it be a monthly income or an annual income. And what they're saying here is that they'll guarantee that amount for as long as you live, even if the account value, the rest of the money in the annuity, falls to zero. So even if it runs out of money, it's still going to pay you for the rest of your life. And that's very, very important. That's peace of mind that, people are really loathing for in retirement. And it's something that I don't think you can really put a price on, knowing that in combination with your Social Security, now you've got another income source that's guaranteed for the rest of your life. So coverage is available for you and your spouse when you begin lifetime withdrawals. You can decide if the withdrawals will last for your life, structured as a single life, or as long as you live and you and your spouse are alive, which would be a joint life structure. Withdrawals can be taken monthly, quarterly, semi-annually, or annually. And then protection when you need it most. Wellness withdrawals are automatically included with your annuity. This is a great feature, y'all. Listen up. After the second policy year, you can receive a wellness withdrawal if you cannot perform 2 of 6 activities of daily living. Those are things like eating, bathing, dressing yourself, continence, walking. So if you can't perform 2 out of those 6 activities of daily living, then you'll qualify for the wellness withdrawal provision that's free of charge in this annuity. And if elected, the single lifetime withdrawals, then the wellness withdrawal will double the amount of the lifetime withdrawal. Wellness withdrawals can last for 5 years. Okay, so let's put that into perspective. So if you get into retirement or you get into that period of time where you're like, okay, I'm ready to convert this to an income stream, and you turn on the lifetime income, if that income amount, let's just say it's $12,000 a year, guaranteed for life, if you qualify for the wellness withdrawal provision, then that $12,000 will double. So it'll go to $24,000 a year. And that'll be used to help you cover the cost of long-term care or any other expenses that may come along with that illness. So it'll pay that $24,000 amount for 5 years. And then after 5 years, it'll just revert back down to the $12,000 amount if you're still around during that time. Now let's talk about accessing your savings in the annuity. So this is one of the things that we get. Another misconception is that, oh, well, if I put my money in an annuity, I can never access it without a penalty. False. Okay. 100% of these indexed annuities on the market today offer some sort of free withdrawal provision. Now, it might be 5%, it might be 10%. I've seen them as high now as 20% of your account value on an annual basis that you can access without any surrender charges or penalties incurred. In this particular product, the Denali fixed indexed annuity from Silac, you may withdraw up to 5% of your account value as of the most recent policy anniversary. Free withdrawals will not be subject to withdrawal charges, market value adjustments, or bonus recovery percentages if applicable. You also can use this annuity for qualified dollars. So if you have an IRA or 401k with tax deferred treatment on those dollars, you will be required to eventually pay required minimum distributions at the age of 72. And when that happens, Silac will help you take those RMDs out of this account in the event that that's something you need to do. So RMDs can begin immediately and are considered a free withdrawal even if they exceed 5% of the account value. So very important benefit there. And then the other benefits in this annuity is in the event your health declines after you purchase your annuity, you may withdraw funds without being assessed a withdrawal charge, market value adjustment, or bonus recovery percentage, if applicable. These riders are provided at no additional cost. So the nursing home benefit, after the first policy year, you can withdraw up to 100% of your annuity's account value if you become confined to a qualified care facility for at least 90 consecutive days and meet the eligibility requirements. There is a waiting period of 1 year after the policy issue date, and you cannot be confined at the time the policy is issued. So another misconception is that, well, if I need money from the annuity and I have a health event or something that I just need more than 5%, I'm screwed. Well, that's not true. In the event you qualify for a care facility, which is the 2 out of the 6 activities of daily living, the nursing home benefit provision will allow you to access 100% of your annuities account value with no penalty. Terminal illness benefit: after the first policy year, you can withdraw up to 100% of your annuities account value if you are diagnosed with a terminal illness that results and you have a life expectancy of 12 months or less, and you meet the eligibility requirements. You cannot be confined at the time the policy is issued to qualify for that benefit. Self-explanatory there. 12 months or less to live, you can access 100% of your annuities account value. Home health benefit: after the first policy year, you can withdraw up to 100% of your annuities account value if you need home health care services and meet the eligibility requirements. Okay, moving on. Thanks for sticking with us through this. I hope you're getting some value here. If you have any questions or you're interested in comparing this annuity or any other annuity on the marketplace to another to determine, if it's the right one for you, you can visit our website at annuityassociation.com. Right there on the main page, just click the green button to request a free report, and we'll get one out to you in a timely fashion. Income options: in addition to withdrawals, the Denali series can provide a guaranteed income stream of your choosing. You may elect to receive income monthly, quarterly, semi-annually, or annually. After the income waiting period, the payment amount will be based on the account value. Before the income waiting period, it will be based on the cash value. Wealth transfer: the Denali includes automatically a death benefit to help leave a legacy for your loved ones. Your beneficiaries will receive the annuity's full account value. Your loved ones will avoid the delays and hassle of probate, and the death benefit will be paid as long as an annuitization option has not been elected. So annuitization option is if you decide to annuitize the contract and convert it to a lifetime income stream. Spousal continuation: if your spouse is an owner or a beneficiary, then he or she can always choose to continue the policy. And then important considerations. So we've talked about the withdrawal charges. It's just saying that if you withdraw an amount that exceeds the free withdrawal amount during the withdrawal charge period, you will incur a withdrawal charge. A withdrawal charge does not apply after the withdrawal charge period ends. In part, withdrawal charges allow us to invest your money on a long-term basis and generally credit higher interest than possible with a similar annuity of shorter term. So they're just basically saying that, hey, you got 5% free withdrawal. If you withdraw more than that 5% amount on an annual basis, then anything above 5% will be subject to the withdrawal charge at that time. And they're trying to educate you that the reason that a withdrawal schedule exists or a surrender schedule exists is because in order for these insurance companies to offer these benefits in an indexed annuity such as the 0% floor, they have to know that you're going to keep your money in the account for the duration of the contract. That's how they make this work, is that knowing, hey, they're going to keep their money in here for 7, 10, or 14 years. That gives the insurance company peace of mind knowing that they have time to invest their dollars that they're matching your investment with to earn interest in the ways that they invest money so that they can offer you the opportunity to grow your money as well. Market value adjustment. A market value adjustment applies to any withdrawal to which a withdrawal charge applies. It can either increase or decrease the amount you will receive. It does not apply after the withdrawal period ends. And then bonus recovery. A bonus recovery will apply to any withdrawal to which a withdrawal charge applies. The bonus recovery schedule is a percentage of the annuity's bonus, and the bonus is equal to the account value less any premiums and includes interest credits. Bonus recovery percentages decline with time, meaning that less of the bonus is recovered over the annuity's withdrawal charge period. It does not apply after the withdrawal charge period ends. In part, bonus recovery allows us to credit higher interest than would have been possible otherwise and offer a lifetime withdrawal benefit. So on these Denali annuities, sometimes they'll offer a bonus. If you invest, they're going to give you a bonus of 2, 3, 4% or so, depending on the bonus that's offered on any premium dollars that are invested. So if it's a 2% bonus, you invest $100,000, your contract would be credited $2,000, so it'd start with $102,000 value. Now that bonus is vested over the duration of the contract. So if you withdraw above the 5% per year that you have as a free withdrawal provision, then they're going to take back some of that bonus on any of the value that's withdrawn above that 5% per year. So the bonus is an incentive to keep your money in the contract. That's really the intended purpose. I always advise clients don't get caught up in the bonus. But in this case, this product is a very, very good growth focused indexed annuity. And the bonus here is really just a bonus in the way it's structured. So definitely don't overlook the bonus in this one. But keep in mind that anything above the 5% withdrawal, they're going to pull back some of that bonus on those dollars. Okay, let's see what we got going on here. Policy values, they're just showing an example of the way it looks on a chart for the account value comparison. So you've got the traditional fixed indexed annuity with the line with the circle on it, and then the Denali 7, which is the green colored line, and then the gray line, which is the fixed indexed annuity with guaranteed lifetime withdrawal benefit rider and the fee that's associated with the rider. So it looks like what they're trying to do here is basically show the account value and how it's associated with the annuity and how it compares to another indexed annuity that has a fee. So let me go ahead and read this for you. I think this is important to cover. So it says chart 1 compares the account value of a Denali 7 policy to a traditional accumulation focused indexed annuity and to an indexed annuity that offers a guaranteed lifetime withdrawal benefit for a fee. The account value is the policy value that interest credits, death benefits, lifetime withdrawals, wellness withdrawals, free withdrawals, RMDs, nursing home withdrawals, terminal illness withdrawals, and home health care withdrawals are tied to. It also provides the cash value after the withdrawal charge period has ended. A few key points. So it says the Denali 7 has the higher account value throughout because it provides the larger interest credits and doesn't have a fee dragging down the account value. And the fixed indexed annuity with a guaranteed lifetime withdrawal benefit and fee has the lower account value because it provides the lower interest credits and has a fee that reduces the account value. So they're giving an example here. Basically what they're trying to allude to is that their value proposition is that they're giving you an indexed annuity that not only is structured for safe accumulation and very competitively structured for that, but also because of it not having a fee on the lifetime income rider, you don't have to worry about that fee eroding the principal. So for example, in an indexed annuity that has a lifetime income rider with a fee, if you have a crediting period, so let's say you're in a 1-year point-to-point crediting strategy and the index performs negatively, so you have a 0% credit, even though the 0% credit is there because of the guarantees of the contract and that 0% floor, because of it also having a 1% fee because of the rider, you would actually, if you had $100,000 in there, you would lose $1,000 for that given year because the 1% would still be charged. So that's what they're trying to show, that the Denali not only gives you very, very competitive growth options on the index strategies, but because there's no fee, it's going to grow just like an accumulation focused indexed annuity, but also have that lifetime income rider at zero charge, giving you added value. So I think that's important. That's a great illustration. Okay, chart 2, doing the same thing here, except they're showing a traditional accumulation focused indexed annuity, and again, another one with a fee for the lifetime income rider. And it's showing, how it really compares, giving to what would happen in the event the markets perform. So down here at the bottom, it's saying the key assumptions include issue age 60-year-old, $100,000 initial premium in the traditional indexed annuity assumes a fixed interest rate of 2.35%. The Denali bonus 7 assumes a fixed interest rate of 2.5, and the fixed indexed annuity with a guaranteed lifetime withdrawal and fee assumes a 1% fixed interest rate and a 1.15% fee. Okay, so what they're trying to show you here is that inside the Denali, it also has that fixed account. The fixed account on the Denali right now is 3%. In this illustration, they're illustrating 2.5 on the 7-year. And it's showing you a competitor offering a fixed interest rate at 2.35, and then another competitor that also has a lifetime income rider with a fee. Traditionally, you'll see that the interest on the fixed interest accounts, okay, in an indexed annuity with a lifetime income rider are usually lower. So they're saying that the feed version only offers a 1% fixed interest rate, but the 1.15% rider fee is eroding the principal. And that's what they're trying to show you with that gray line, how it's going down. But you still get the lifetime income rider with the Denali and the higher fixed interest credit because of the higher fixed rate. Very cool there as well. So, all right. So the basics here, 7-year, 10-year, and 14-year versions. The minimum issue age is 0. Max issue age is 90 on the 7-year. 85 on the 10-year, and 80 on the 14-year. Minimum investment premium is $10,000 for all three, and the additional premiums allowed in the first 12 months cannot exceed $1 million in total premium. So won't cover all that stuff again, but if you're not familiar with Silac Insurance Company, they have been in the industry since 1935. They're formerly known as Equitable Life Insurance Company. They did recently change names. Have not dove in yet on why the name change occurred, but I do believe it has something to do with another company sharing a similar name. So this company was called Equitable Life. There's another company out there just called Equitable. I think it's Equitable Insurance Company, or Equitrust. No, it's Equitrust and Equitable Life. I think that had something to do with it. They are a B+ rated insurance carrier. So if you look at AM Best, let's go ahead and dive into that real quick. AM Best ratings is the standard for rating the financial stability of the insurance companies that offer annuities and life insurance. And if we look at their guide, let me make this a little larger for you. We'll see that a B+ rated company is in the rating category of good. And that category definition is assigned to insurance companies that have, in AM Best opinion, a good ability to meet their ongoing insurance obligations. Now, we think that a B+ rating is still a sound rating based on AM Best and their rating schedule or rating score or rating scale rather. Obviously, the better rated companies are going to offer more peace of mind, but keep in mind, if you're located in any of the 50 United States, most states offer a similar investor or consumer protection safety net, if you will. It's called the Insurance Guarantee Association. It is a state governed body of protection. So similar to how the FDIC works with your deposits in a bank, on the insurance side, they use an Insurance Guarantee Association, and many states offer a protection minimum of $250,000 in investments to insurance companies. That includes annuities. And in the state of Florida, it's up to $300,000. So I think that's important to note. So keep that in mind if you're considering a B+ rated company. Don't let that, deter you, because there's a lot of value that you can find in these B+ rated companies, because in general, they have to compete with the bigger players. And in order to compete, they have to offer better rates. So in order to take advantage of those rates, you can do that by finding them in a B+ rated company, and just know that you have that safety net from the Insurance Guarantee Association. If you're interested in finding out what your state Insurance Guarantee Association covers in terms of dollar amounts, you can go to annuityassociation.com. Just fill out the request for a free form, or a free report rather. Fill out the form, and when you get the automated email that comes out with your report, it'll have an area where you can contact me directly there, or you can just call me directly by going to the website too, or shoot me an email, but I'd be more than happy to help you find that. Okay, so we have gone into our brochure. We are now going into our software that is going to dive into the participation rates, cap rates, and spread rates, and take a look back at the historical performance of the Silac Denali fixed indexed annuity to see, how this thing's really performed over the last, 10, 15, and 20-year periods. So let me go ahead and pull that up. This is one of the, I guess I would say, value adds that we provide prospective clients, is not only educating you on the various annuities that are out there on the marketplace and the features and benefits of them, but we're also able to do very robust back testing to see what the hypothetical performance would have been if, we owned these contracts during various periods of time. So I really think it's important to be able to make an educated decision is, how have they done? What would they have done if everything was set, the way the contract is set today, but went through the various time frames in the past? What would they have done? And what's neat about this process here is that we're going to go through, in this case, the last 15 years, which will take us from 2005 to 2020. And I think that's very important because if you remember back in 2007, 2008, that was when the global financial crisis occurred and the equity markets were down over 40%. And, we're able to show you what this annuity would have done because of the 0% floor, what the annuity would have performed at even during those difficult periods of time. So we've got this sorted for the Silac Denali. Of course, the 14-year version is going to come out on top because they do offer the highest participation rate inside the 14-year contract. So again, rule of thumb, the longer you sign up for, the more growth opportunity you're going to have because of the higher par rates that are offered in the contract. So if we look at the Denali 14, over the last 10 years, from December 31st of 2010 to December 31st of 2020, the average annual credited interest rate was 9.7%. Now, just below that, you're going to see a green number and a red number. The green number is identifying over the last 20 years, what is the best 10-year period of those 20 years? And it would have been from March 22nd of 2005 to March 22nd of 2015, 11.6% average annual credited interest rate. So very, very competitive there from a crediting perspective. On the opposite side, in the red numbers, you'll see that the worst 10-year period of the last 20-year period is October 5th of 2010 to October 5th of 2020 at an 8.61% credited interest rate. Now, here's where our philosophy comes into play. When we're looking at an indexed annuity, if you're looking for market protection, you're looking to, preserve principal, you're looking for the ability to keep up with inflation, but do so in a riskless manner, or as riskless manner as possible, and you're looking at an indexed annuity and you're identifying that, hey, this might be the product for me, don't make the decision based on what the best case scenario is. Make the decision on what the worst case scenario is. And the worst case scenario, when we look at this red number, it gives us that 8.61%. That's coming from 2010 to 2020. I really think that that's important to consider is like, can you sleep at night knowing that worst case scenario, this might do 8%. It might do a little worse. It might do a little better, but the back testing kind of gives us an idea of that range of possibilities. And I think you need to make your decision based on the worst case scenario, in this case, the worst 10-year period, to determine if this is the right product for you. Now, when you're looking at this interest rate I mean, let's be honest, 8%, 8.61, that's incredible. The S&P 500, for example, the pure equity S&P 500 stock index, okay, from over the last 10 years has averaged 11%. And that's with a 100% of the risk. So in this thing, you're looking at zero downside risk to market volatility, but still earning a very, very competitive interest rate. I think that that's something to really write home about. Now, how does it get there? How are we getting these numbers? Well, we're looking at the index strategy found inside the Denali, and that's called the Barclays Atlas 5 point-to-point with a participation rate. So it's a 1-year point-to-point. So for those not familiar with what that means, when you buy the annuity, you're going to have what's called your anniversary date, which is the day that the policy is issued. So if it's January 1st of the year that your policy gets issued, then you're going to also receive the starting value of the associated index that you're assigned to. In this case, it's the Barclays Atlas 5. So when you look at that index value, fast forward 1 year to January 1st of the next year, you've just now, you've just now eclipsed or gone across your anniversary date. And what they'll do is look at the ending value of that Barclays Atlas 5 index. If the ending value of the index is higher than the starting value of the index, the date the policy was issued, well, then you had growth on the index. Now, if that growth, let's just say it's, for easy math purposes, this is not a number to just say, hey, this is what you're going to get just for easy math. But let's say that the performance of that index for that year was 10%. It had 10% growth. If it's 10% growth, then they're going to take this number right here, participation rate, which is 140%, and they're going to multiply that. Okay, I'm going to bring up the calculator and do it with you. They're going to take that interest, or that 10% growth for the index, and they're going to multiply it by 140%. That means your contract, your annuity account value, would be credited 14% for that year. So again, if the index had 10% growth, they're going to multiply 10% by the 140% participation rate, and that would equal 14%, and that's what would be credited to your account. So the participation rate, all that means is of that index performance, how much do you as the investor participate in? In this particular product, it's 140% of whatever the index strategy was, or the index growth was. So very, very cool there. Now let's go ahead and take a look at the Denali 10 to give those interested in the Denali 10 versus the 14. What did that look like? Well, over that same time frame, average annual credited interest rate of 8.13% over the last 10 years. The highest 10-year period over the last 20 years is 9.73%, and the worst 10 years is 7.21%. Over the last 15 years, the average annual credit interest rate would have been 7.13%. Now, why is it lower? The only reason it's lower, it's got the same 1-year point-to-point and the same Barclays Atlas 5 point-to-point with participation rate. But remember how we said rule of thumb, the longer you go in the contract, the longer one you sign up for, the more growth opportunity. While in the 10-year version, they're only offering 117% participation rate. In the 14-year version, they offer 140. So that 23% difference is the reason that the averages on this analysis here are lower. So on the 10-year version, 117% participation rate. Now let's look at the 7. On the 7-year, again, same strategy, 1-year Barclays Atlas 5 with the participation rate. And on this one, it's 105% participation. So we went from 140 participation in the 14-year down to 117 in the 10-year and down to 105 in the 7-year. And that's why these numbers are lower. 7.31% average annual credited interest rate over the last 10 years. And the highest 10-year period, 8.75. Lowest 10-year period, 6.48. Average over the last 15 6.41 if you were invested in this product during that time frame. So hope that all makes sense to you. Now, is the Barclays Atlas 5 the only index that's offered? Well, let's find out. Let's show you how we do this. I know the answer, but I want to show you. I'm a show it, not tell it guy. So let's go in and assume that we're going to do an illustration. So let's go in here, state of Florida, which is where we're located. Now, we do serve all 50 states. So if you're watching this video from a state other than Florida, we still can help you. We're licensed in all 50. And we set up virtual meetings using Zoom to be able to help address your needs. So let me go back and select the right product. So we got to go into Silac, select the Denali. Let's just use a 10-year version. That's what the average contract usually is in this space. Let's say it's a $100,000 investment. Okay, so in the Denali 10-year version, there are going to be a few different index strategies that are offered inside it. The first one is the one that we just recently reviewed, which is the Barclays Atlas 5 point-to-point with participation rate. They also have the Barclays Atlas 5 with a spread rate. A spread, if you don't know what a spread is basically another word for a haircut, okay? Let's say the spread rate is 1%. Well, if your index strategy, in this case the Barclays Atlas 5, has 8% growth for the year, and it has a 1% spread, they're going to cut 1% off the 8%, give it that haircut, and 7% is what would be credited to your contract. Spread can really be looked at as a fee. It's not technically a fee, but it acts similar to a fee. It's just how much does the insurance company cut off the top once there's been a gain experience. So we don't typically look at spread rates. We're not real big advocates for them. Some annuities that have spread rates, they are, we can argue that they are attractive still, but generally speaking, we like participation rates with no caps and no spreads. Now, the other option that's offered in here from an index crediting strategy is the S&P 500 point-to-point with a monthly sum cap, or the S&P 500 point-to-point with a participation rate. Now, our software is able to go in here and intelligently tell us which strategy is going to give us the highest opportunity for growth when back testing it over the last 10 years. So in this case, we're seeing, the Barclays Atlas 5 par rate, 100% 1 year point-to-point. That's where it shows the average return of 8.13% being the most attractive. So that's where we would really want to start looking. If we wanted to do a illustration showing you income coming in from the just free withdrawal provision, we could do that. But today, for this demonstration, we're not going to. But I want to go ahead and show you what the illustration can potentially look like if you decide to move forward. The first step would be to get a formal illustration from the insurance company. And what they're going to do is show you your investment and back testing it, showing you how it would have performed over the most recent 10-year period. So in this case, in this product, for a 60-year-old person investing $100,000, you'll see that the interest rates are credited every year because of the point-to-point strategy. So 11.62% for the first year, translating to $11,620, and the account being credited with that amount equaling a total accumulation value of $111,620. Now you'll see there's a column for surrender value. That's also showing the fee that would be required to pay in the event you exited the contract early before the 10 years is up. So you'll see that the surrender value column is always lower than the accumulation value within that first 10-year period. In addition, you have the death benefit column. The death benefit column will always match the total accumulation value, regardless of where you are in the contract. So you'll see that it offers the same amounts every single year. And then you'll see the second calendar year, 10.61%, 12.74%, 14.28%. And then in this fifth year, obviously the index had a loss, but because of the annuity and the protections that are offered on principal contractually, it was just credited as zero. You'll see there's no fees in the annuity, zero every single year. And after 10 years, if markets perform like they have their last 10 years, this person's contract would grow from $100,000 to $218,540. Very, very awesome growth with no risk to market volatility. So to wrap this up, we've got the most recent 10-year period. Its average annualized credited rate is 8.13%. The highest 10-year period is 9.73%, and the lowest 10-year period 7.21. So again, it goes back to understanding, don't make the decision to move forward with any annuity on the best case scenario. Make it on the worst case scenario first. And if you can sleep at night knowing in this case that, hey, the worst case scenario thus far that's been tested on this annuity, 7.21%, that's the worst case scenario. If you can sleep at night knowing, hey, I have 0% market loss risk here, no volatility. The worst possible scenario I can get on any given year is zero. But over a long period of time, let's say 10 years, the average is 7.21. If you can sleep at night with that rate, which I think many can, then you should definitely consider it. So if you're interested in finding out more about the Silac Denali fixed indexed annuity, you can speak to me directly by going to annuityassociation.com and visiting the website there. Right on the main page, there's a form you can fill out to request your free report. That would be the first step to start our relationship, is request your free report. Once you receive the report and you take a look and you're interested in speaking to me further, right in that same email, it'll have an option for you to schedule an appointment to where we can get together and I can help point you in the right direction. So thanks so much for tuning in. I hope you found some value here. If you did, please like and share this video with your friends and family, or leave a comment below if you have any questions or if you'd like to let us know how we did. So thanks so much for tuning in. Hope everybody has a great day out there. Take care of one another. Thanks so much. Bye-bye.